The business is predominantly focused on non-US clients. About 70% of our clients are non-US and 30% are US. And most of them, as I mentioned, are operating multi-jurisdictionally, and are operating portfolios that are global. And many of them operate businesses that are global as well. So that's it. And the private bank is in addition to doing investments, obviously does banking and lending, but does a lot in terms of sports advisory work, aircraft lending, art advisory, all of the things you would expect a private bank to do, except that it's on a global basis. So it's a little bit different than operating, just domestically.
Okay. Thanks for that background. So can you tell us a little bit about the past 6 months for your clients? How have they weathered this extremely volatile time, with the initial plunge in markets back in February, March, and then this very rapid recovery? Yeah, how did they weather that?
Well, so I'm going to describe, it's interesting when you run a global bank and a global platform, you really are dealing with different crises at different times. So we first heard about, the events that were taking place when they actually hit China, because we have a lot of clients in Asia and in China specifically, and had a real sense at that time it was thought to be a regional issue. And there was a lot of concern, at that point in time there in those markets. As a result of our having a bit of a heads up, by the time the end of February came around, the private bank was already talking to its clients about what was about to take place, and the fact the pandemic was on the horizon really about 10 days before the World Health Organization and certainly before the CDC, issued the warnings that they did in the United States in early March. So we were out giving, clients a lot of information about that. I think that the impact to markets, the severity and depth of that impact, probably nobody anticipated. And interestingly enough, as a result of the fact that it happened so quickly, it actually didn't cause an enormous amount of dislocation because markets went down. There was a whole bunch of, I'll describe what our clients have been buying and selling in a minute, but there really wasn't much time to react. And quite frankly, what really happened subsequently was an assessment that we had to make about what the likely markets would be going forward. And I think our clients have been net investors, by the way, during this time, and I'll explain why. But we began publishing data based upon the financial support that we thought was necessary. One of the first pieces we wrote was a piece saying that the United States needed to spend $3 to $4 trillion in order to prepare for bridging the chasm that was going to be caused by the shutdown of the economy. And ultimately, they initially came out and said they were going to spend less than that, and they ultimately spent that much. What we didn't realize was that spending in the United States would actually be mirrored all over the world. We estimate that the spending is between 11 and $12 trillion by governments all over the world, in fiscal support, with an enormous amount of money spent, obviously in terms of central banks providing liquidity and financial support to make markets orderly. So when we realized that was going to be the response, we became somewhat optimistic about what was going to take place in markets. And began advising accordingly. The second thing that we noticed was a trend of substitution. So had this crisis occurred in 2008, I don't think the world would be in the shape that it is today, because the level of substitution of technology has been extraordinary, whether it's in education or in finance, in terms of transportation of goods and services, the ability to actually operate, entire businesses from home had never actually been tested before. So when that became a requirement, we began seeing that to be the case. We even saw that at Citi. One of the odd things that my joke was that we would send 20 people home or to an alternative site to see how our backup systems worked, last November. And now I was sending home everybody who worked for me all over the world, 770 people. And we were able to function our capital markets business and things, from home. With all the attendant regulatory requirements. And I think that was the experience that many, many businesses had. And seeing that, you saw this incredible shift to technology. And interestingly enough, markets responded accordingly. You saw the price and value of these technology companies go through the roof. And so that seemed consistent with us. And so the markets have been pretty discerning in terms of how they've either punished or rewarded companies based upon their ability to handle and weather these circumstances. And then in the fixed income markets, what's been pretty remarkable about that has been the rapid race to zero, right? We have now more than $17 trillion worth of debt that is either zero yielding or near zero yielding or negative yielding. And that, of course, created challenges in portfolios for clients that we had to deal with as well. So a lot really happened in a relatively short period of time, and we adapted by providing much more information to our clients and obviously much more, real-time recommendations on what to do and how to manage portfolios during that time.
Yeah. Okay. So, so let's talk about some of those things that you touched on, the ultra low rates environment, and we saw the Fed underline that yesterday with a commitment seems to go to 2023. How do you approach portfolio management with in that environment with treasuries yielding so little? What are you advising clients on their fixed income portfolios?
Right. Well, when we were talking yesterday, you and I about today's conversation, one of the things I went and looked up and I said, the 10-year is at 70 basis points. The 10-year 8 months ago is at 1.9%. So we've seen rates move an extraordinary amount. And one of the things I would say is that if we look a year out and a vaccine is found, or other treatments, and I think there will be other treatments, we're going to see rates higher than where they are today. It wouldn't be surprising if the 10-year was at 1.25 or 1.5, sometime a year from now, and therefore a steeper yield curve. And what we can talk about the opportunities it presents for clients, which is itself an opportunity. But putting that aside, it also creates risk for clients, because if rates are as low as they are, right, and what I just said actually happens, you can lose a substantial amount of money in your fixed income portfolio in a whole variety of ways if you're not careful. We've also had yield compression take place as a result of the Fed's intervention in markets. That's another risk for clients. And so I think the risk return characteristics, Megan, of fixed income have really turned unfavorable for clients over the course of the last several months. And we've been advising them actually of that and reducing our exposure to that. So that's number one. And number two is our clients are no less in need of yield than they were, right? 6 months ago, right? It was already a difficult market then. We were already talking about low yields when they were below 2% on the 10-year.
Yeah.
So I think the reality is that there's an enormous amount that clients have to be wary of, right? They have to get properly compensated for for what they own in fixed income, and the diversification benefits associated with it have clearly diminished. So what we're focusing on right now, I think, are a lot of fixed income substitutes, and a lot of them happen to be in equity-related markets. I'll just give you just a quick rundown of what those might be. So first of all, there is some areas of the world where you can still get yield, right? There are some parts of the high yield market. There are some parts of bank debt markets and things where risk is worth taking, right? Where you're going to get 4 or 5% for some of those in terms of yield. But there are some much more attractive markets. So for example, in equities, we can start with preferred equities and especially the preferred equities of financials, which, even though they've done well in recent weeks, I think represent a compelling yield because of the fact that the underlying financial companies are doing well and are likely to do even better next year. You can look at, dividend stocks. Dividend stocks have been one of the areas of underperformance in COVID. They've done that because of the fact that dividends have been put under stress, whether or not they would get paid, and certainly for smaller companies, whether or not they could be affordable. But as we come out of that, we think that dividend securities are going to do well, right? You can see an average, global yield of nearly 4%. And if you combine that with some appreciation and earnings increases and maybe some dividend increases, the total return of that can be particularly attractive. In other markets, take a look at mortgage REITs, take a look at commercial mortgage REITs, residential mortgage REITs, and some of the BDC companies in the world. You can see yields of 8 or 9% that are available. If, again, you have to pick out which ones you want to be invested with, but there are opportunities there to get that yield and to maybe see some appreciation because they're trading some of them below book value, some substantially below book value today, because investors are concerned about the underlying credit worthiness of those opportunities. We think that credit opportunities will improve. The credit conditions will improve because of what you said. Those are very attractive. So there's a range of things, but those require somewhat more risk. And then in the alternative investment space, obviously you have even further yield you can pick up if you're willing to deal with some illiquidity. And those are markets in areas of supporting private equity or different, the financing of companies that are having trouble accessing accessing capital markets because they're in emerging markets or because you're too small to get access to markets. So there's a lot of opportunities if you're willing to consider those things as fixed income substitutes. And a lot of our clients, by the way, a lot of our clients have done that.
Okay.
One other opportunity is that we've seen, just as an example, our clients have done, in the aggregate, more than $10 billion of structured notes this year. Literally money that would have otherwise gone into public markets have actually moved into these structures, that provide different return and risk characteristics, because of the market conditions.
Okay. Okay. So in this, exodus or hunt for yield, is there, I mean, you alluded to the risk of this. Is there a risk building up that there are going to be bubbles in some of these other sectors of the market that people are rushing into because they're getting virtually nothing for holding a treasury?
Yeah, I mean, I think that the flight to risk, I think, is what you're talking about. The flight to, the flight to quality from risk, or the flight into fixed income because of risk, has been significant. And of course, it's been accelerated by central banks that wanted to ensure that markets had the liquidity that they needed. And companies, obviously benefited from lower rates and an extraordinary level of refinancing that took place this year. I forgot what the number was, but I think this was the greatest amount of bond issuance in history in the shortest period of time was 2020. So if you're an investor, though, if you're on the other side of that and deciding where to put your money, you ask yourself, are you getting paid adequately for the risk you're taking? The answer is probably you're not. Yeah. And as a result of that, you're not getting the diversification benefits in portfolios that you otherwise would have gotten.
Yeah.
So that to me is really where the unseen risk is. It's not so much in the security that you're buying, but you're not adequately being paid for it in terms of return. And so, so to me, the answer to your question is, I think people have to be wary of fixed income and have to change their portfolio asset allocation such that they probably have, my joke at about a month ago was that, 60-40 equity is the new 50-50, right? We all talk about 60 as the new 50 in terms of our age, but that's really how I'm looking at it. We want to have our clients overweighted in equity and use equities like the ones I described as a substitute for fixed income.
And within that 40 fixed income, how much would you suggest devoting to treasuries and how much to alternative fixed income?
Yeah, well, so depends, of course, on the risk return profile of the client. But to answer your question, the U.S. is obviously a more attractive market because it has any positive yield, right, relative to others. But for the clients that are more aggressive, right, that had more cash going into the crisis, we're seeing a bunch of them do half of their fixed income allocations to the areas that I outlined. Whether it's liquid debt or in different areas of the market, which where they're taking quote more risk, but they're earning 8 times or 7 times what they would if they were invested in treasuries. So it depends on how aggressive they are, but it's a considerable amount of money that's moved in that direction over the course of the last couple of months.
Wow. Okay. What about your clients' cash on the sidelines? How fully invested are they?
So I have a story to tell you that your listeners don't know anything about, which is that our clients had a lot of cash coming out of 2009 and 2010. Some of them more than 20% of their portfolio was in cash. And guess what? During the ensuing decade, they kept their cash balances high. They actually had too much cash for almost the entire time. One of our big themes going into 2021 is to actually convince them not to do that, because it's interesting that there's a perception of safety by having a lot of cash, but the truth is that the amount of cash you need, right, is something. If you said, how much cash would you like to? If I asked a client today, how much cash would they like to have for the next 10 years, where they had to commit to that amount, the number would be less than 10%. So what that means is that half of the cash that clients are holding, they're holding with the intention of putting it to work and then don't. And the reason they don't is they're not sure when to enter the market. They're actually thinking about when to time the event. So what we're advising our clients to do is to ask the question, how much cash do I need to have for the next decade? And then to invest the remainder of that cash now, because we don't want them to be market timers. There are plenty of things to invest in today that are attractive given our view in 2021 and 2022, when we expect equity markets to do better. And obviously, some of these areas, in fixed income to recover, the REITs and other things like that.
Mm-hmm. Mm-hmm.
I think Megan is frozen.
So have their cash balances come down? Are you still telling them to, invest more cash? Oh, I'm sorry.
Yeah, that's okay. No, we're
Yeah.
yes, we can. I mean, yes, we're advising them more aggressively, because of the history of the last 10 years, we're advising them to be more invested, to move money out of cash and into these other opportunities now, because actually the opportunity cost is much, much greater than the amount of safety that they're going to, have by holding that cash.
Okay, so, and let's rewind for a couple of weeks back when we had the quite a significant sell-off led by tech. What were your clients doing then? Were they thinking that's a good opportunity to maybe use some of my cash to get into a market that maybe had that market been getting away from some of your clients? Have they been sitting on the sidelines and seeing the massive rise and waiting for an opportunity, and that was an opportunity?
Yeah, I don't think most of our clients view so just to give you some numbers, the NASDAQ was up 40% at that time. When it was done with the 11% drop, it was now up 29% for the year. So it was really hard to argue that this was a bargain opportunity, and again, it was really the top 50 stocks and really the top 10 stocks that actually, had the largest moves. I think that the technology run, has surprised investors in general, and a lot of our clients have made an enormous amount of money, holding those securities because they've had them for a long time. And the reason they've had them for a long time is because the Citi Private Bank's been, talking about the digital disruption, about the opportunities in digitization for years, and our clients have been building up positions in that. Our concern was actually the opposite one, that their portfolios had too much exposure to technology, and especially to technology, media, and telecom, as a result of the outperformance of all of those things during the pandemic. And so we've been advising our clients to actually have a different, actually to reduce holdings in technology before this took place, probably prematurely. I mean, we were probably, ahead of the curve there. One of the reasons why we wanted them to have, exposure outside of tech and media and telecom is because some of these other markets are still very cheap. I'll just give you, there's a lot of markets that I think are going to do very well next year. All of the small and medium-sized industrial companies globally and in the United States. The emerging markets themselves are going to have, we think, a lot of tailwinds in 2021. And then, beyond that, when you take a look at specific, subsets like the financials, in particular, you can see different areas of the market where there can be considerable profit opportunities. And we wrote about this. We divided the world exactly in half between what we called COVID defensives, that included technology shares that were going to do well in this environment, and COVID cyclicals. And taking that definition and running it back 30 years, we had never seen such a dispersion between these defensive shares and the cyclical ones. So it's an enormous opportunity for us today to see those things mean revert, right? To see the cyclical shares catch up. And part of that is going to be that these defensive shares, including technology, will perform less well. And that's exactly what started to happen. And I think we can see more of that over the next 6 months.
Okay. Any other areas of opportunity you see in the markets? I mean, are you betting on value?
Yeah, I mean, well, part of that cyclical and defensive part is value, right? We wrote about this the other week. We think that value has to be somewhat redefined, because finding value by looking at the balance sheets alone, right? Stocks that are cheap based upon their balance sheet is not the only definition of cheap that one should be using, now. We think that there are companies that are growing more quickly and are undervalued, right? But don't have, balance sheets that indicate that they're cheap. Or we think that there are parts of the market, and a good example would be materials, right? As opposed to, industrials versus materials. Material shares and commodity shares have done very well, but a lot of the industrials that use them have done less well, right? When we see a dispersion in activity like that, we think that's an attractive place to put capital. But to answer your first part of your question, when you look at what happens after a financial crisis, and you were to go back to 08, 09, some of the things that are going to happen in private equity and real estate and in the hedge fund space, I think are going to be very attractive. Some of the best returns that you can generate are after these crises. And we're certainly seeing the recapitalization of companies. We're seeing a lot of pipes that get done. We're seeing a lot of distressed companies that need capital acquire that capital now. And we think that the companies, the private equity firms and funds that do that are going to be big beneficiaries of that. In the hedge fund space, I think you're going to have a period of time when the ability to be a stock picker is going to be easier because of the circumstances I've already described, identifying companies that can do well now and having them perform disparately from the indices will actually be something that will benefit hedge funds. I think the hedge funds that will have a harder time are those that have to do, fixed income arbitrage, or anything where, the spreads and yields are simply not there and the leverage is not available. I think they're going to do terribly, terribly badly. I think we're going to see a wave of bankruptcies, and those are going to happen in the future. They've slowed down as a result of the fact that rates are lower. But eventually, some companies are simply not going to survive, and those companies are going to go through restructuring, and that'll become an area in the future that I think will be attractive for our investors. And so we've seen a very large amount of capital move into these alternative investment spaces, and then with high degree of specificity. So, when you think about real estate, where the bankruptcies will actually happen first, there's a lot of people obviously who want to put capital to work to buy those assets, and you'll see that in retail, and you'll see that in hotels and other parts of the market as well.
So have your clients' allocations to alternatives, so these more illiquid alternatives, risen during?
Yeah, no question about it. Certainly in the last 3 months, right? We've seen pretty extraordinary demand for all of the alternative investments in the last 3 months. And of course, we're preparing for the next 6 to 12 months in terms of developing opportunities for them to put even more capital to work. I think that'll be a definite theme, from now through 2021.
Were there any issues though with clients that invested pre-coronavirus and then maybe had, got stuck in some illiquid investments which were not performing so well?
Yeah, no, listen, I'm sure some of the funds that actually, put money to work over the last 12 to 18 months are going to have some stress in them. No question about it. But I would say that the majority, that these lower fixed income rates are going to really have buoy that marketplace, right? I mean, it would be one thing if rates were materially higher, right, and capital was not available. But the exact opposite is the case today, where capital is plentiful and rates are low. So I think that even private equity funds over the last couple of years will probably do better than you think, that because of the fact that the low rate environment will save some of that activity. But answer you, I think what the heart of your question is, did investors feel distress, prior to this event? And I think the answer is largely no. One of the things we wrote about too is this idea that, the savings rate in the United States and globally, but in the United States hasn't been higher for like 25 years before this crisis. It was really high. Balance sheets of our clients were really strong. Their businesses were doing very well and unemployment was very low. So it wasn't as if there was an enormous amount of stress going into this. I think what was stressful was actually the crisis and the fact that it was global at a time when the world had been deglobalizing, right? I mean, the lack of cooperation between countries, the lack of coordination in the response to the healthcare crisis, the fact that the response, generated a whole variety of different healthcare outcomes, all of that, right, and different messaging, I think was, exacerbated the experience that clients had all around the world. And one of the benefits of being a client was that we were actually able to tell them what was going on around the world, the different responses in China versus the US, what was going to happen in India and Brazil subsequently. These are things that we could see on the ground. And they had deep implications for markets. They still do, in terms of how those markets have behaved as a result of that.
So I want to switch gears a little bit and talk about the looming event of the U.S. election. Are your clients feeling maybe nervous about putting capital to work ahead of that event if the outcome is so uncertain? Do you see a lot of volatility, in various scenarios?
I would say in general, the clients have been putting to work. Our business has been relatively consistently strong and not going up or down over the course of the last 3 months. And certainly September has started to be a strong month as well. So I would say that behavior hasn't changed much, but if you take a look at implied volatility and the forward yield curve, the forward volatility curve, clearly clients are actually expecting volatility to increase over the course of the next several months. In fact, the volatility, even after the election, is supposed to be higher than it would normally be in principle, because there's some possibility that we won't know the results of the election on the first day. It may take a few days or even a week, to find out what the election results are if it's close. And secondly, I think that while the polls, right, show Biden ahead right now, they typically tighten before almost every election. And we haven't had the debates. There are 3 of them coming up, one this month and 2 next month, and plus the vice presidential debate, which I think will be heavily watched. And so we have a lot of news to generate between now and the actual election day. And then, of course, mail-in voting, which is going to be predominant this year, and especially, but more prevalent for Democrats than Republicans. But it will be very important, and it will take place it's already underway, in many jurisdictions. So, we're definitely set up for, for what could be a more volatile period on that basis. Ironically, of course, regardless of who wins the election, assuming, I think the bigger news will be the actual, production, availability and production of a vaccine that works, and monoclonal antibody treatments that work. And those are, maybe a late December or next year event, but they're on their way. So what we're advising our clients is that, in a sense, you've got to look over the election. Clearly, if the Democrats were to win, then there are parts of the market that'll do less well initially as people anticipate policies of healthcare changing and the like, or more regulation. We think it's going to be unlikely the Democrats are going to walk in if they were to win and immediately raise taxes. That fear, I think, is an overstated fear. I think it's much more likely that both governments, whether it's Republican or Democrat, would have to have an increase in spending, really to make sure that the economy had the necessary support to grow. We think that's far more likely than it is that you all of a sudden have these, and of course, we remind our clients all the time that the Republicans have been spending far more in the last 2 decades than the Democrats have. So it's a time when I think fundamentals are going to matter more than we might think. But to answer your question, I think there's no doubt that higher volatility is likely over the course of the next couple of months.
Okay. And then to your point about the big event being a vaccine that, is able to be distributed, widespread and used. What do you think the market react? I mean, has that all been baked in to prices, or are we going to have a real run in equities?
Yeah, well, we could have a real one. I'll describe it in a couple of ways. First of all, we had the Russian vaccine come out, and if you take a look at that day, that it came out, you saw what happened in the market. You saw, value stocks do better, and you saw the equity markets rise, and whatever it is. So, this is one of those things. It's not like you can present value the vaccine, right? It's a black and white thing. If people not only see that the vaccine, a properly tested vaccine that's gone through the full rigorous testing that you would expect for something that's going to be used by 1 billion people around the world. This is not something where you want your testing to be, incomplete. You want full testing, right? You're going to use this, and because you're going to have to take 2 of these shots, it looks like, not just 1. Anyway, when that's announced and that testing is complete, and there are more than one source of the vaccine available, more than one company, we're gonna see, I think, a very marked pickup in enthusiasm for the market. But let's assume for a moment that was 5% or 10%, some very large move. The larger move is going to be that COVID cyclical and defensive thing, where you see these value-oriented stocks improve and industrials improve and emerging markets improve, and you're going to see the tech stocks either go down some or at least stay stable. That to me is going to be the big market move. It'll appear to be small in indices, but it's going to be really large in the rotations that take place within the market itself. And that's what we're positioning our clients for today, is a rotation within the subsectors of the market. And that's where people are going to make, I think, a fair amount of money. So we're very focused on that. That is in my mind. And then, if that takes place under a vaccine or monoclonal antibodies or both, you're going to see rates go up as well. As I mentioned, I think you're going to see a steepening yield curve there, as the economy itself is going to be, the degree to which people are sure of an economic recovery will be higher.
And I think you're a fan of banks, so which would also benefit from the steepening yield curve.
No question about it. Their net interest income will go up. The economic environment will go up. The credit worthiness of their clients will go up. The amount of loan loss reserves they have will drop, probably next year to 0. And eventually in 2022, there'll be some loan loss reserves. I think it'll be benefiting other financial companies, not just banks, but insurance companies that'll benefit from that. that have longer dated, asset liability issues. And so, I think that financials in general will be benefit. And then, of course, credit-oriented companies that are, providing credit, to riskier clients and companies, I think will be beneficiaries. So there'll be a whole group of companies that'll be benefit, during those circumstances.
I mean, we have had the rotation into value has been talked about a lot and not really happened.
That's right.
Why are you so confident that this time it's really going to happen?
Yeah. So as I mentioned, we sort of redefined value, right? So it's a combination of even a growth at a price. So when we look at it, well, let me answer the question, I think, in a very direct way when it comes to this. We're in a healthcare crisis. This is not a normal economic cycle. It's not as if these relationships, right, between defensives and cyclicals have ever been they're as wide as they've ever been. And the reason is the pandemic. And the only when the pandemic is going to go away, are you going to have the kind of rotation that we're talking about, right? So when it's going to occur is when you can see into the whites of the eyes of the end of the pandemic. I don't think that value itself is going to come back. It's going to come back as an index, but it's going to again be a rotation, even within those subsectors. And so small and medium-sized companies that have lost competitive advantage are not going to come back, right? You're going to have to see companies that are well-positioned, that have good balance sheets, that have access to capital, et cetera. They're going to come back. And I think that the creative destruction part of this environment, is something that investors are going to have to assess as we go. So I think that it will happen, but why it hasn't happened yet is because we don't have confidence that we see the end date on this pandemic. We don't know.
Right. Okay. I wanted to just see if there are any questions from the audience. So I'm just going to ask Marek if there's anything come through, and I'll keep a look on my screen. But if you're out there in the audience and have any questions, please do send them through. And while we're waiting for some questions, I'm going to ask on a bit of a different topic that we were talking about, which is the wealth inequality effect. That this is the virus impact has caused a lot of concern about the acceleration of wealth inequality. So, and you're advising people really at the upper echelons of wealth. What role do you think the high net worth community, the family offices that you're talking to, what role can they bring to this? To try and solve some of these issues.
It's a great question because our clients are incredibly philanthropic and also have values that they want to express in their portfolio. So I'll address that in a couple of different ways. So first of all, it's absolutely true what you said, which is that if you think about the economic impact of this pandemic and where it's been the worst is in some of the most vulnerable populations, right? And vulnerable countries from a healthcare standpoint. 200 to 300 million people immediately unemployed in areas like restaurants, hotels, all travel-related activity, in education, in healthcare, ability to provide regular healthcare. So real, destruction of these industries, and the people there are some of the least well-paid, employees of any industries in any of the world. It just worked out that way. So there is a lot to be done, and a lot of our clients are involved in social causes and activities. In providing food and essential services in some cases, but are very, very involved in efforts to both, with governments and independently to address some of these immediate concerns. From an investing standpoint, a lot of our clients are moving portfolios into these ESG strategies in very serious ways, where they're looking to invest in companies whose conduct during times like this is really tailored to do the right thing ethically with their own employees, in their communities and things like that. And so we're seeing a lot of money that's moving into ESG strategies, looking at companies that are doing that. And then there is some activity, I would say a small amount, but this is a trend that we would expect to accelerate, of people investing in green projects or projects that are going to actually, cause, the quality of life, basic services and things to improve, in developing nations and in the poorer parts of developed nations where there is real exposure. And those can be in the form of green bonds or other activities where there is a real reduction in return in place of the need for measurable results in terms of social impact, and we've seen a fair interest in that as well. So it's true on the one hand that these clients have been less affected, but these clients are also a source of wealth to redeploy, to address some of these issues.
Okay.
The longer term issues of wealth inequality, I think, are a different subject, than this, although a lot of our clients have an interest in that as well. But I think that's sort of how things are being seen right this second. Okay,
thank you. So that we do have some questions from the audience. So so one is, in case of a second wave, what sectors would you be expected to do better than others if there was a second wave?
So we just presented some data today. It's a great question. There's been some behavior that you would not have expected among of consumers that I think is remarkable. And let me tell you two parts of that. So, even though you have in India and Brazil, these incredibly large impacts, and in the United States, even though it's going down now, we've seen a return to travel that's been remarkable. I'm not talking about airline travel, but I'll give you an example. So if 100% was the number of people in offices today, 35% of those people have not returned to work, and that hasn't changed over the last 3 months.
Yeah.
If you take a look at people who are actually, in terms of mobility data, going back to retail centers or actually taking advantage of public recreation, they've gone from 100% back to 88% as recently as last week, implying that regardless of actually the pandemic's impact, people are becoming more active and their mobility indicates that they are. When you take a look at retail sales, not only here, but in Europe and in Asia, retail sales in America, as an example, are above what they were in December of 2019 by more than 2%. Total sales. So, when people talk about the second wave, the question is, will consumer behavior get constrained in a second wave? And the answer is, we're not so sure that it will. And that's because of the substitution effect, where $1, right, that was going to be spent on travel is now being spent on appliances, right? Take a look at housing. Housing data in the US this last week, intent to purchase, mortgage applications, all up, right? Lumber prices up 100%, right? These are things that indicate that the consumer is going to continue to spend through the second wave. So I'm less concerned about the second wave from an economic impact. I'm very concerned about a health impact. We still have 30,000 Americans dying a month from the pandemic. We could have 400,000 people dead by the end of the year because of the fact that the health response hasn't been strong enough, and mask wearing and other activities, social distancing, haven't been taken seriously enough. But when you take a look at the economic impact, it's not the same as the health impact, and that's kind of surprising. Yeah. So what does that mean for markets? It means not much. In other words, we don't expect a second wave of disease, which, by the way, we built into our economic models for the fourth quarter, that they're necessarily going to have the impact that one would have expected. The negative impact might not be as great.
Right. Right. Another question, actually back on our previous topic, to do with climate. And is there potential for growth with green bonds and ethical stocks given the climate issues?
No question about it. It's interesting. There have been a couple of climate issues. Number one, of course, we've had the tragic, fires all over the West Coast, like we've never seen before. We've seen that take place in Brazil as well, where you have extraordinary fires in the forests there. You've seen, 2 hurricanes in the last week, hit Alabama and Louisiana. This level of activity is significant. And obviously, whether you only have to look at the data to understand what's going on in global warming. So clearly, that's a major issue and one that I think is there. the other thing that we saw is that, due to the pandemic, especially during the period of industrial shutdown, we saw how fast the environment can be cleaned up. And so for me, as an investor, when you think about what can accelerate, the evolution of electric vehicles, whatever numbers we had applied to that before, that growth rate is going to be twice what we might have expected now. No question about it. The same for electric vehicles, including trucks, and that type of thing. Battery technology is going to become greater. The generation of power from solars and from roof tiles themselves will grow enormously and faster than we might expect. And so these trends will be accelerated. They're investable trends, which is good, and they're also good. They're good for the environment overall. And because of that, it's sort of like, if you're religious, you sort of look at these the trends in climate as really incredibly negative, bad, things to fear. But what's interesting is that human ingenuity is coming up with solutions for a lot of those. And so, there in my mind is a lot that can be expected, in the future for climate change that's positive, right? That can be addressed, and a lot of that will be addressed and also create investment opportunity.
Are your clients big fans of Tesla?
Yeah, we were asked about that the other day. Obviously our clients have made some money in Tesla. I think, we've seen they're invested in it, and it was funny. We saw a lot of clients in Asia actually get exposure to Tesla because of Tesla's opening its plant in China. So it's been interesting to watch. So I guess the answer is yes, but I mean, it's not been a specific recommendation necessarily.
So I think we're coming up on 45 minutes. I just, sorry, can you still see me?
We can't, but we can see your name. So that's
good.
There you go. Do you want to wrap up with any closing thoughts? I mean, I guess maybe my one last question for you is what, take it anywhere you want, but what worries you most? Looking at that. I think that, what worries me most really is that we want people to have confidence, in the vaccine creation, that they'll take the vaccine and not believe that the studies are being rushed. I think it's very important that people have the confidence to be able to take the treatments that are going to become available and that they take them. And clearly, if they didn't do that, then obviously the pandemic can last longer if people aren't willing to take the treatments when they're available. So that's definitely on our minds. I think that government policy in 2021, right, support of the economy is going to continue to be needed. You saw the very dovish stance from Jerome Powell and the Fed yesterday. I think that indicates it's going to take time for the world markets to heal. And clearly, governments have to stand ready to be of help, and I worry about that. And you raised one of the other issues that we worry about, which is clearly not only income inequality, but this is a huge setback for economies that were on the mend, and for some of the developing world. They're going to be more damaged than not, and clearly, that's a concern of ours as well. So there's a lot to think about. On the other hand, we are very optimistic about the total global economy and its ability to grow through this. We think it's, things have accelerated. Both the damage of the pandemic was faster and greater than we would have anticipated. The recovery looks like it's going to be faster. It really is a V-shaped recovery. And so, from an investment standpoint, we don't want our clients to miss that. We don't want any clients to miss that. So if you're listening today, and you're not an ultra high net worth family, and I'm not an ultra high net worth family, my advice is to take our advice, is to actually put your money in the markets in the places that we've identified, to be fully invested over the course of the next couple of years, to have the cash that you need, but not more than that, and to be optimistic about the future, because I think there are reasons to be so. And that's sort of what I'd like to leave people with. I'd like to leave people with that feeling, that things are going to be okay, and your portfolio should be ready for them to be okay in 2021.
Well, thank you very much for that. We really appreciate your time.
Anytime.
And thank you, everybody, for listening.
You bet. Have a good day today.
All right. Thank you, everyone. Bye.